Good day everyone, hope you're well. Today we are going to have a look at financial statements. All of the information in this slideshow or video comes from your new era textbook for grade 10s, accounting for grade 10. So, desirable characteristics of financial statements. Accountants are eligible to become members of a professional body. For example, the South African Institute of Chartered Accountants, known as SAICA in South Africa, or the South African Institute of Professional Accountants, known as SAIPA. Bodies such as these regulate the conduct of accountants who are eligible to be members of their organization. The public thereby gains assurance of the quality of training, performance, and ethics pertaining to accountants in public practice. In other words, if you are a SAIPA or SAICA qualified accountant, the public know that they can trust your work. These bodies are also responsible for providing guidelines to their members on procedures. This is referred to as the GAAP, General Accepted Accounting Practice. One of the guidelines relates to the preparation of the financial statements to ensure that they meet certain minimum standards. It is desirable that the financial statements of a business should have the following characteristics. Comparability. It should be possible to compare the financial statements of different businesses, and it should be possible to compare one year to another. This is possible because all accountants follow this same amount of or same procedure of setting up financial statements, the GAAP procedure. Understandably, it should be possible to understand the financial statements of businesses. Reliability. It should be possible for readers of financial statements to rely on the figures contained therein. Fairness. The financial statement should not favor any one group of people at the expense of another. For example, they should be impartial. Timeless. The financial statement should be issued as close as possible to the date of the period for which the financial statements are prepared. The year and procedures are summarized as follows. A pre-adjustment trial balance is prepared. Then journal entries for year-end adjustments are recorded and posted to the general ledger. Then a post-adjustment trial balance is then prepared. Closing entries are recorded in the general journal and posted to the general ledger. A post-closing trial balance is prepared, from which financial statements will be set. When closing entries are posted to the general ledger, all the nominal accounts, income and expenses accounts are closed off to the trading account and profit and loss account. These two accounts are prepared in the final account section of the general ledger. In the trading account, the gross profit is determined, sales less cost of sales, while the profit and loss account reflects the net profit or loss. Gross profit plus other income less expenses. If the result is a net loss, total expenses are higher than the total income. The balance sheet accounts remain open and are recorded in the post-closing trial balance. Financial statements consist of an income statement and a balance sheet. The information contained in the income statement is identical to that shown in the final accounts. Trading and profit and loss accounts. While these two accounts are prepared in T-account format, the income statement is set out vertically in an easily understood format. It does not have a debit or credit side and can easily be read by a person who has no formal training in accounting. The information contained in the post-closing trial balance is recorded in the balance sheet. Financial statements contain the same information as the final accounts and the post-closing trial balance, but are drawn up to show certain additional information in the form of notes which simplifies analyzing and interpreting financial results for an accounting period. The information contained in financial statements may be of interest to several persons or institutions. The owner who needs to show or see how well his business is doing, the financial statements enable him to determine if his investment in the business is profitable enough for him to continue operating. Potential buyers need to know the profit growth potential of the business. Creditors grant credit to the business. An examination of the financial statements will enable suppliers to establish the creditworthiness of the business, for example, its ability to pay its debts. Banks and other lending institutions use financial statements for the granting of loans or overdrafts. The South African Revenue Service, SARS, for income tax purposes. The manager or other senior personnel uses financial statements to make financial decisions. Employees and trade unions use the information contained in financial statements as a tool to negotiate wage increases or improved working conditions. Before moving on to study financial statements in greater detail, it is necessary for us to appreciate the concept of accounting period or the financial year. The only way in which we can absolutely sure or be absolutely sure of the success or otherwise of a particular business is to gain an idea of its net worth at the beginning of its life and the net worth at the end of its life, and compare the two. This would, however, be impractical because a business could continue for hundreds of years. The life of the business therefore gets divided up into different periods, usually 1 year, and the financial results for those periods can be compared to identify whether or not the business is on a successful path or not. It is not necessary for a business to use a calendar year starting on 1 January and ending on the 31st of December. They may use any starting and ending date. For example, if the business decides to start its financial record keeping on the 1st of March 2002, then the period for which the financial statements are prepared will end on the 28th of February 2003. If the period begins on the 1st of July 2002, then it will end on the 30th of June 2003. The date decided on by the business is referred to as the accounting period or the financial year, as opposed to a calendar year. The period chosen by a business for the calculation of its net profit, usually 1 year. The business can determine the start and the end of a financial year. Just a quick summary of a financial year. Operating, financing, and investing activities. It is also necessary to identify the difference between the main groups of activities of a business. In order to interpret financial statements correctly, every single transaction in a business can be classified in one of the three broad groups of activities. Operating activities, in operating the business, for example, buying and selling goods activities, paying wages, etc. Financing activities, in raising funds for the business either from the owner or from a lenders. For example, owner provides capital, borrow funds from a lender, repay a loan, pay or earn interest. Investing activities, and investing the funds of a business with the intention of earning activities a profit. For example, invest in a fixed deposit, transfer funds from saving account, earning interest. Note that the definition of investing in this case is used in a broad sense. For example, investing in land and buildings and other fixed assets. By using these fixed assets, the business will enable itself to operate and thereby earn a profit. Income statement. The purpose of the income statement is to determine the net profit or loss for the accounting period under review. The income statement is set out as follows. A net profit is assumed. Sales less cost of sales will equal gross profit. Gross profit plus any other income, for example commission or rent income, will equal gross operating income. Gross operating income less operating expenses will equal operating profit. Operating profit plus interest income, for example interest on investment, will equal profit before interest, expense, and financing costs. Profit before interest expenses or financing costs less interest expense or financing cost will equal net profit for the year. Note: the net sales figures used to determine gross profit. Net sales consist of total sales, cash and credit, minus debtors' allowances. Interest income and interest expense are shown below the financial statements as separate notes. Interest income is shown separately in the income statement because it consists of income earned from outside sources, banks and other financial statements, and not income obtained from normal business operations, operating activities. Interest income is shown as Note 1 under the notes to the financial statements. Interest expense is also shown separately in the income statement because the expense is not a normal operating expense such as stationery, repairs, etc. Interest expense is paid to persons or institutions who lend money to a business. Interest expense is shown as Note 2 under the notes to the financial statements. Operating profit shown, the profit derived from business operations. Interest income is added to this figure and interest expense is subtracted, resulting in a net profit or a loss. An income statement can be drawn up from the final accounts in the general ledger or from the nominal account section of a post-adjustment trial balance. Balance sheet. A balance sheet reflects the financial position of a business on a certain day, usually the last day of the accounting period or financial year. It shows the assets, the owner's equity, and the liabilities of a business. A balance sheet has two main headings, assets and equity and liabilities, with subsections for each major heading. Assets. Non-current assets, it's fixed tangible assets. It's also Note 3, land and buildings, vehicles, equipment, including computers. Financial assets, fixed deposit maturing after 12 months. Remember, non-current is longer than 12 months. Then current assets shorter than 12 months is inventory, Note 4, trading stock and consumables on hand. Trade and other receivables, note number 5, trade debtors, income receivable, accrued income and prepaid expenses. Cash and cash equivalents, note 6. Fixed deposit maturing within 12 months, saving accounts, bank, cash float and petty cash. Equity and liabilities, owner's equity, note number 7, capital balance at the beginning plus additional capital contributions minus capital withdrawals, you know it as drawings, plus minus profit loss minus drawings. Non-current liabilities, loans repayable after 12 months, and then current liabilities, trade and other payables, note number 8, trade creditors, loans repayable within 12 months, expenses payable, accrued expenses, deferred income, income received in advance, bank overdraft. If you've missed the school buzzer, there you go.